Hi everyone, it's Sean Lee from Unwavering Capital. TSMC released a strong Q1 2025 earnings on April 17, and today I want to discuss the highlights, compare it with what I had predicted on my last TSMC initiation pitch, and share my new thesis and risk. As I accurately dismissed the Intel JV potential, TSMC indicated that it isn't pursuing any JV tech licensing. There were persistent speculations by major press and so-called experts that TSMC will be receiving a 20% share in an Intel manufacturing JV through its contribution of tech and personnel. Given that the management dispelled the rumors, investors should no longer factor in the drag such cooperation would have brought to TSMC's operational bandwidth and the threat that it could have been imposed from enabling a competitor. Despite the market's concerns about the impact of tariffs on TSMC, it hasn't seen any change in its customer behavior so far. Although some may say this could be due to demand pull forward, the fact that TSMC hasn't cut its 2025 Capex guidance assuages my concern that this may not be the case. Although TSMC previously guided gross margin dilution from overseas fabs within the 2 to 3% guidance range, it is now saying that it will widen to 3 to 4% in the latter stages, which is 2.5 to 5 years from now, factoring in inflation. Although I was about to assign a lower free cash flow multiple as of the disappointing revelation, I was reassured by the news that TSMC isn't considering raising prices for 4nm chip production at its US facility by as much as 30%. As I noted in my earlier write-up about TSMC's strong pricing power, I believe it has plenty of room to exercise its competitive advantage. Thus, I give the management of the benefit of the doubt and trust its ability to comfortably meet its gross margin target of 53% and higher. Now, moving on from earnings recap, I'll now discuss my first thesis. Regarding hyperscalers pausing some data center projects, it's important to keep things in context. The headline that Microsoft is slowing a $1 billion data center construction in Ohio drove TSMC stock down on fears that a massive infrastructure expansion might not need quite as powerful chips as expected. However, investors must be cognizant of the fact that the hyperscaler reiterated its plans to stick to spending $80 billion on AI data centers, and the large possibility that its recent scaling back could solely be due to a shift in its close relationship with OpenAI, and not because it expects a declining AI demand from other clients. As Microsoft is no longer the exclusive provider of OpenAI's computing power, Microsoft could be in the process of halting early-stage projects. Oracle, which is now taking on Microsoft's capacity to fulfill OpenAI's needs, has recently signed 2 sizable lease deals. Thus, OpenAI's robust deals have been shifted to a different cloud provider and have not been diminished. Similar clarification may be needed for recent news of AWS pausing some new colocation leases. While investors are fully pricing in slowness in computing demand, AWS could have pulled back from a pipeline of LOIs due to a host of other reasons, such as utility power sleeping or supply chain constraints. For instance, Google last year walked away from 2 gigawatts of signed leases and slowed into second half of 2024, only to re-accelerate meaningfully in early 2025. Since AWS hasn't changed its $100 billion annual Capex plans, investors shouldn't discount the slight possibility of cloud providers growing their spending budgets in 2026 and beyond. Second thesis is that there isn't any definitive evidence available yet to determine the ROI of AI spending. Therefore, doubting the sustainability of TSMC's AI orders based on its customers' premature data is wrong. Since NVIDIA is TSMC's top 2 customer after Apple, I estimated to contribute 17% of TSMC's 25 sales. I read NVIDIA's bear thesis. D.A. Davidson analyst cited the 1% decline in Microsoft's ROIC from 2023 to 2024 and the low ROAs of CoreWeave and Nebius to make a case that since a surge in GPU spending has only translated in deteriorating returns, NVIDIA's customers will likely decelerate their AI capex. But there are many errors with this argument. First, ROIC is a lagging indicator, and I believe it's too early to make a trend analysis based on one-year data. Secondly, a small drop from 21% to 20% may be a reversion to the mean. Moreover, CoreWeave and Nebius are growth companies that are expected to show low ROI in the early stages of their life cycle due to their heavy upfront investment business models. Thus, I hope my rebuttal of NVIDIA's bear narrative by refuting their evidence and therefore their claim that customers' returns don't appear supportive also dispels TSMC's doubters. I believe a better guidepost to gauge the robustness of AI demand is TSMC's Capex guidance. Since the 2025 capital budget remains between $38 billion and $42 billion, 70% of which will be allocated for advanced process tech, there is no reason not to trust TSMC's management's reaffirmation that its revenue from AI accelerators will approach a mid-40s percentage CAGR for the next 5 years period starting from 2024. My third thesis is that incremental gains from Intel outsourcing would far exceed any share loss to Intel Foundry in the next 5 years. Intel recently commented about keeping TSMC outsourcing at a reasonably high level in future years as well. Currently, it outsources about 30% of its wafer production to TSMC, which is a positive change from 6 months ago when Intel was planning to bring back all wafers in-house. Deducing prior comments from Intel's head of product during its earnings call, I think it's likely that Intel would outsource data center CPUs to TSMC in the medium term, and since TSMC's current capacity plans for Node 2 likely don't factor in big orders from Intel, this could represent upside to TSMC's capacity plans and Capex. Now, let's shift gears and talk about the risks. First, tariff uncertainties will likely persist longer than I initially expected. Although I correctly predicted my previous base scenario with a high 60% probability that tariffs on semiconductor exports would be imposed, I presumed it wouldn't last too long. But I'm afraid that Trump is more unpredictable than I had initially estimated to be, even with US Secretary of the Treasury now expecting de-escalation in the US-China tariff fight. For instance, after I posted my write-up on Substack last Tuesday, China today declined any trade talks with the US despite White House hints at easing tensions. Therefore, I'm lowering my one-year price target to TSMC from Taiwanese $1,200, $8 to $1,051 to reflect my new hypothesis that Trump-led uncertainties will likely persist throughout his presidential period. However, I still stand firmly on my earlier prediction that TSMC will be exerting its strong pricing power and that its end customers will bear the increased cost. That said, I'm making a higher possibility of 20% that this would have a negative 10% negative impact on end demand, which is next to 12 months sales year-over-year growth, especially in consumer electronics in my downside scenario. But long-term investors should take some comfort that now the risk-reward ratio for TSMC is higher from 2.3 times a risk-reward in my initial report to 2.5 times. My second underappreciated risk is that the stock will plummet if either TSMC or hyperscalers cut their 2025 Capex guidance. Many investors have already either erroneously or too prematurely priced in both of these scenarios happening, as mentioned in my report. For one of these events to occur or both, readers should interpret them as my signs to indicate that I've been wrong about my analysis of TSMC's strong AI pipeline and that it is when to cut our losses. Now I'll discuss TSMC's valuations. In the long run, fundamentals are gravity. If you look at the chart of TSMC's stock price, free cash flow multiple, and next 12 months cash flow per earnings per share, you will observe that TSMC business has been generating strong returns, as I correctly forecasted in my last initiation report. The recent poor stock performance has been primarily due to the multiple compression driven by uncertainty around tariffs and fears that the chip demand cycle has peaked. If the next quarters continue to generate stronger than expected business results, I believe TSMC stock price will eventually reflect the fundamentals as it has always been. Thanks for watching, and I hope to see you again soon.